Inflation is coming back, and it is returning at the worst possible time when economic growth is going in the opposite direction. Markets are starting to get unmoored. We're about to get economic data that's perhaps going to make the situation look worse still. On that happy note, this is Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive, and we are going to delve into a bit of a conversation about what is perhaps the scariest thing for markets and policy makers alike, and that is stagflation. There's a situation where growth and inflation are moving in opposite directions, whereby growth is weak, but inflation is rising. This is, of course, a terrible mix of things to happen, because from a central bank's perspective, it's difficult to say whether you should cut rates or raise them. From the perspective of government officials, it's very difficult to provide some sort of backstop to the economy, even through the regular channels of unemployment benefits and such, because that just fuels inflation. And so the prospect is a scary one, and one that everybody is very eager to avoid. We've heard worries about it emerge in recent days from Fed Chair Jerome Powell, from JP Morgan CEO Jamie Dimon. It's beginning to appear more and more, and although this is a bit of a unicorn of a scenario, it is very, very rare that it actually occurs. The evidence seems to be piling up, and we start with a look at the news that came through overnight. It comes from the UK, where we get a significant jump in inflation. Now, we were expecting to see a meaningful increase, but it turned out to be even larger than expected. The markets were looking, in fact, anticipating that some structural factors in the UK for this month, namely a rise in utility costs, mandated utility costs as of April 1st, as well as a new excise tax on electric vehicles, that would be inflationary, that the cost for water and energy and other kind of utility inputs would rise, and that transport costs would rise, and that this would be inflationary, up from a rate of 2.6% in March to 3.3% in April. We ended up with 3.5%. Moreover, core inflation jumped to 3.8%, also higher than expected. And the retail price index, which is a favored gauge for the Bank of England, it jumped from 3.2 to 4.5 versus 4.2 expected. So significantly higher inflation readings across the board. We can see the reference points for this is somewhere in the beginning of 2024. So these are 13 and 15 and 12-month highs on these measures. Now, this follows in a sequence. We've seen higher inflation numbers out of a whole host of major economies this week. The revised set of European, that is Eurozone numbers, significantly higher, 2.7%, a sharp rise, the highest in 3 months. The core rate in Canada surging unexpectedly to 3.1%. That again has a reference point in early 2024, so a major high there. And we can see how the markets have read the results. So while in the UK the issue was fuzz around, again, what you could shrug off as one-off factors, like an increase in excise tax or an increase in the price cap on energy, by the energy regulator. Similarly, you could do the same thing in Canada and say, oh, well, this weirdness in the inflation numbers has to do with an expiring carbon tax, and this will all even out. All of those ideas may be well and good, but the markets are telling you very clearly how they're interpreting these numbers. Front-end interest rates are up for both the UK and for Canada in the wake of each of their inflation reports, which tells you that what you are seeing is the markets downgrade rate cut expectations in the wake of this data. So very clearly, rates higher, and the expectation that central banks will have to be slower in any reaction function that they have to any kind of a growth scare as a consequence of the inflation numbers that we've just seen. The story in the U.S. is a bit fuzzier. As we've mentioned, the latest CPI numbers were kind of encouragingly normal at first sight. Most critically, of course, no big surge in goods inflation, something that was a legitimate scare given all of the tariff back and forth. But that seems to now be a mirage, because when we later got the PPI version of the data, as we've discussed here before, we saw this shock decline in month-on-month PPI. And that's even as goods inflation increased and was some of the fastest that we'd seen since early 2023. So the goods inflation seemingly is in fact arriving. The cost of the tariffs is in fact appearing. But then service costs, and we can see this is that big decline right here, suggest that businesses are eating that increase. They're not passing it on to consumers, and they're taking the hit in margins instead. In fact, a 1.6% month-on-month hit to margins, which is quite a thing. That's a lot for a single month. And what you see here then is why it doesn't show up here yet. Businesses are just absorbing it. They're not letting it get to consumers. But the inflation is indeed there. And for what it's worth, we have, of course, seen a moderation in Fed rate cut expectations, where we see that having expected many more rate cuts at the sort of peak panic in April, we've now unclenched, and we're sitting now even a little bit to the hawkish side of the Fed's own outlook. The markets now see 46 basis points this year, 47 rather next year. That's almost exactly what the Fed is saying, 50 and 50. What's interesting, perhaps, is that the cumulative number of rate cuts over the past several days in particular has started to increase, but not because of what might happen this year. So again, central bank action seems to be hemmed in, and rate cuts are starting to push into the further year. They're starting to go into 2026. Now, you don't quite see it in U.S. yields today. They're significantly higher at the long end of the curve, perhaps around all of what this means as an initial proposition. But you are starting to see that the markets are angling preliminarily here to say there is inflation on the march. Central banks are in no position to act now, but they are going to have to act eventually, and perhaps with some degree of catch-up. And this is where the second piece of this puzzle comes in, the growth part. So we got the deflation in stagflation. Here comes the stag. Here is the expectation set for the PMI numbers from S&P Global that are due to come out here over the next 24 hours or so. And we're going to get updates for Australia, Japan, the Eurozone, the UK, and then, of course, the US. And perhaps the most worrying part of this, besides the fact that most of these things are expected to go in the wrong direction, a slowdown in the composite reading for Australia, and of course, just to remind everybody, this is as ever around a center line of 50, where 50 is neutral. Above 50 is growth, below 50 is contraction. The higher you go above 50, the faster the growth, The lower you go below 50, the faster the contraction. And so here, for example, for Australia's composite PMI here, which takes in both manufacturing and services, scaled for their contribution to the economy, we see here 50.7 from 50.1 would imply that there is growth, but it has slowed. In Japan, same thing, still growth, but near standstill levels, barely a hair above 50. Same story in the Eurozone, although here we're hugging standstill for a second consecutive month. In the UK, expecting a move from contraction to essentially standstill, so not exactly the most encouraging story there. And in the US, standstill and at a slightly weaker setting. So the two that really stand out here are the US, of course, and the Eurozone. And the reason why these two in particular are in focus is because, of course, these are two of the world's top three engines of global demand. We can see here, we look at this chart a lot to give us context. Global GDP is 58% just three economies: the US, the Eurozone, and China. We're not going to get the China update on the PMI data this week. That one is usually a little bit delayed. We'll see that one later. Next week and the week after is when we start to see those numbers begin to come into view. But for now, we get two pieces of this three-piece puzzle. Moreover, this 42% in the rest of world component right here, most of these economies are dependencies. They're vendors to these economies. They feed demand coming from here. And so, really, it's these three that set the tone. And what we see is already as of April, the overall composite here, this is the global PMI set, that's given us the lowest growth in 17 months. And the concern, looking at this here, would be if of the three big ones, there is ongoing standstill in the Eurozone and ongoing standstill in the US, that May is not going to be much better than April. That we're going to keep looking at anemic conditions. Which lines up with how we've sort of developed since the beginning of the year. Last year, we can see already from mid-year, the Eurozone situation and the China situation was going in the wrong direction, from higher to slower and basically flatlined growth, whereas growth was strong in the US and then at the start of the year started to race lower and is now basically lined up on neutral and on standstill across all three of the major economies here. This is, of course, the recipe for what could be a global recession. And that at a time that inflation seems to be perking up. In fairness, this is survey data, but it isn't without backing in hard statistics. Recall that in the first quarter numbers for US GDP, we saw the weakest consumption growth in almost 2 years, going back to the second quarter of 2023. That's, never mind all of these distortions from a surge in imports and a surge in inventories to front run the tariffs, because they don't matter that much. We can see consumption is 68.5% of overall GDP. Everything else is collectively much lower, and the trade side is barely 4.5% as an influence overall. And then, of course, if we consider investment levels, in this case, it would be non-residential investment that would house this jump in inventories. We can see we're talking about numbers collectively below 20%. So we're really focused on consumption as a driver of U.S. GDP growth, and the first quarter gave us a worrying setting. Last week, the soggy retail sales report, despite consumers being insulated, as we just saw in the PPIs, along with where consumer confidence seems to be, that is sinking. We're back to levels here lining up with the lows from where sentiment settled in the wake of COVID. And that's as inflation expectations 1 year forward surge, again, feeding into this stagflation story. Obviously, expectations are not realized inflation, but if consumers begin to behave as though inflation is in fact going to jump to 7.3% next year, and they're going to reduce their consumption accordingly, well, then we're going to start to see that show up. That becomes a real economic outcome. And so, as you put all of these pieces together, you increasingly come to the conclusion that if these PMI numbers are leading you to something that the hard data is catching up to, and that something is a global slowdown, perhaps a global recession that occurs in tandem, and at the same time, all these efforts at deglobalization are predictably giving you higher prices. Because indeed, if globalization is designed to reduce friction for goods going, and for capital, of course, going up and down the global supply chain, and that makes things cheaper, then clogging up those supply chains with trade barriers makes things more expensive. So it is only right that in the wake of what we're seeing in the dismantling of global trade, or at least in the hemming up of global trade with significantly more barriers, that prices are going higher. And that growth is suffering at the same time. This is about as stagflation risk of a situation as it gets. Now, of course, stagflation isn't on the menu at the moment in terms of its actual reflection in the economy, but that need not be what happens. It is merely speculation that we are on a glide path there, which would in fact be a nightmarish scenario for central bankers and government officials and markets alike. That's enough. And while it's tempting to say that the turn lower that we have in stocks today has to do with a bad U.S. bond auction or the increase in the U.S. deficit around what may get passed as a budget bill in Congress, it's now sort of making its final rounds in the House, with maybe another between $4 and $6 trillion as a consequence added to the debt. It's tempting to say that this is what's going on, but these are not the types of things that have spooked markets. The U.S. deficit is growing is not news to anyone. That the situation with the sort of rollout of policy is unnerving and building risk premium in bond markets, and that's starting to hurt demand. That's not news. The news that Moody's has downgraded the U.S. credit rating, that's almost laughable, because if the credit rating isn't assigned to the most eligible borrower and is in fact some sort of abstract standard, then what meaning does it have? And is there a more eligible borrower than the issuer of the world's irreplaceable risk-free asset, the Treasury bond, and the steward of its irreplaceable currency of commerce, the US dollar? Those things have no alternatives in the present space. So does it make sense then to say that this is not the most eligible borrower, and if it still is the most eligible borrower, that it's not belay. That's probably not what this is. Once the dust settles, the upshot here may well be that it is that we're going into a growth downturn that central banks are going to have to allow to fester for longer than would be ideal by a long shot, because what they're going to need to see is for inflation to be broken by demand collapsing, because they are not in a position to act until that happens, to be more forward-looking, more preemptive. And that's understandably a negative growth and a negative earnings outlook mix for risk appetite. And so while we've only just preliminarily started what looks like a turn lower from resistance here on the S&P, if we were to breach these levels here, then the rally in stocks here against the backdrop of this incoming PMI data may well be coming undone in a more lasting way. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio. You can get the Wall Street close and where things may follow therefrom. I'm on with Chris for Futures Power Hour Mondays and Fridays. On with Victor Jones for The Price of Truth on Tuesdays. Back with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. If you're watching on YouTube, like and subscribe and comment. Macro Money is back tomorrow. Happy trading.